Well, folks, don't sue me, bro, but we know it's on everyone's mind, and yeah, I pressed the music button a little late, but you know what? We've all been worried about a recession. And in this video, we're gonna go through some unique recession indicators. There are two. There are two indicators in this video that you probably haven't heard of before, and then we're gonna look at a B of A piece on what just happened with something called thrust in the stock market, something we briefly touched on already, but with a different perspective here from B of A. So let's talk about those three things. The first thing that I thought was incredible was this piece here by T.S. Lombard. Now keep in mind, when you hear T.S. Lombard, you should immediately be thinking bear, okay? They are bears. Their entire staff, I don't know what it is, but they're just bears. It's just like, it's gonna crash, it's gonna get worse, it's all gonna go to crap. But for some reason, they're also very balanced, so I like them because they actually give some realistic POVs of things to watch for, so I appreciate that. You know, they make it very clear that their stance is, look, the credit crunch is going to probably crush us into a recession. Okay, fine. However, they're also reasonable here, and they say, hey, look, when you look at the US inflation dashboard, basically on the left, when it's very red, it means inflation's going up, and on the right, when it turns blue, it means inflation is going down, and as you can see, it's starting to trend down, right? So they're realistic, they're like, okay, things are getting better, that's wonderful, things are disinflating, great. They still hold their mid-year recession forecast. But take a look at this particular chart. I thought this was a very interesting one that I haven't considered at all yet when it comes to a recession or not. And it's called the title here, Chart 4, Hotel Room Rates Not Yet Signaling a Recession. And I thought about this a little bit, mostly because of Ross Gerber. Every time I meet Ross Gerber, and I just met Ross Gerber in Deer Valley, Utah, and Ross Gerber, I sit down with him as he's eating lunch with his family, and he's like, Kevin, there's no recession. Look around. And I'm like, it was pretty busy when we were there. But it made reading this chart right here made me think about my meeting with Ross, because to some extent, yeah, when you're in a recession, hotel rooms tank. And because people travel less for vacation and people travel less for business. This makes a lot of sense. So in a weird way, maybe you could look at the CPI report as a tool, which is actually doing a really good job for you. I mean, if you believe the government's work to that extent. If you don't, then obviously it's CP lie. But anyway, every month they are looking at a basket of hotels, and they're looking at the difference in pricing of those hotels. And so far, as you can see on this chart, hotel pricing is still recovering pretty well. Now, it's possible that it's recovering because it went so deep into a hole, but then again, we've already had this recovery, fall, and then recovery again. See, we actually went negative on this chart without having a recession or an official recession yet. Technically, last year, we already had a recession, right? Let's jump over here to the CPI report because we had 2 quarters in a row of negative GDP. Jump into the CPI report. What do you have here? Lodging away from home. Let's understand the headlines of the CPI report really quick. So we're going to look at the right 3 to get our seasonally adjusted, and then the left 2 to get our unadjusted. So if I type in lodging, there we go. So these are going to be the seasonally adjusted right here. That's your SA, and these are your unadjusted. Okay, good. So what do you have? Well, unadjusted, you got some big numbers here for lodging away from home. Are these percentages? 7 point. That's got to be year over year. Hold on a second. Let's go back to the front of the CPI report. And these are year over year. Oh, okay. It's year over year and then month over month unadjusted. Okay, got it. I was gonna say. All right, so we jump on over here. Well, that's actually still, wow, what? No, that can't be possible. Hold on a sec. They both have to be year over year. Am I reading this wrong? No, I'm not. Look at that, unadjusted percent change. March 22 to March 23, and then Feb 23 to March 23, which is a 1 month change. And the CPI report here on the unadjusted side is really suggesting lots of inflation over here on the unadjusted month over month. But either way, on the right, you can see on sort of the seasonally adjusted, yeah, you're still getting this explosion. I guess it makes sense. 2.7% growth in lodging away from home month over month. I mean, think about what that is annualized. 2.7% annualized is a 32.4% increase on a year-over-year basis if that lodging away from home goes on like this. And you can see, look, it's actually getting worse. If I draw this as an orange highlight right here, look at that. We go from 1.2 to 2.3 to 2.7. The prices for hotels are going up, not down. That's very interesting because according to TS Lombard, that's literally the opposite of a recession indicator, where generally when you go negative, deeply negative on hotel room pricing, that's when you tend to be starting a recession. Now, it's possible that you're already in a recession when hotel rooms go negative. In fact, if I look at this a little more closely, you can kind of see here the recession on the left in 2001 starts here, just about where hotels are about at that 0 point. The recession here has an inflection point first on hotel rooms. So you do see an inflection point down, right? So you see an inflection before you get the recession. You don't actually get the depth until you're in the recession. But look at that, even over here during the COVID era, you see the full a few months before. So really, this is suggesting, hey, in order for us to go into a recession, we need to at least see hotel room occupancy on the CPI report for April, May, June. We could get those 3 months. And if all of a sudden we get that in hotels, it could be a recession indicator. Kind of interesting. It's a good tool to pay attention to. It's not the only one though. The second one, and then we'll get into B of A. The second one I want to look at is this. Oops, it's not that one, but I'm going to talk about that one as well. That one's pretty cool. This one. All right, so this is from the Greed and Fear Index, which is a Jeffries piece. And they talk about how small businesses have slowed hiring plans to the lowest level since May of 2020. And when we look at this index over here, I drew red lines on it to make it a little easier to identify these areas of declines. But you can clearly see small business hiring goes down very slowly. And it tends to lead to a recession when it goes down. Now, in fairness, it really led to this sort of mild, nonsensical recession over here in the early 90s. But it does appear that every time you have the small business hiring plan turn from growth to bear mode, you do go into recession. And that's what we're starting to see over here on the right. We're just now starting to see this small business hiring plan rotate down. It's still way elevated though, because if I take the bottom of where we are with small business hiring plans, draw that across the board, we're still at, I would say, the upper third of the historical average of this chart, right? I mean, if I draw across sort of a midpoint over here, this top section here would be the top third, this would be your middle third, and this would be your bottom third here. And we're clearly still at the top third, but that's because of this massive enthusiasm that small businesses had during the COVID era, probably because of all the stimulus money. I mean, starting a business in 2020 and 2021 was great. Here's your small business survey on wage hike plans, and you see a decline on wage hikes. But again, if I draw from that low point all the way over, we're actually sitting probably at the top 15% of plans to raise wages. Small business optimism is one of the only things where we're actually starting to go low, along with small business CapEx plans, which you can see these two charts here are at relative lows. These are probably in the lower 20% threshold. So you kind of have mixed signals here from small businesses where everything is clearly declining, right? CapEx and optimism plans are down, wage hike plans are down, hiring plans are down. However, hiring plans are still at highs when you look at the early 2000s or the mid 2000s. So I think both of these indicators together suggest that we probably still have more time to go before we're in a recessionary environment. Now, Barclays did a phenomenal piece here on what happens with stocks in various different circumstances of basically recession or not. And I'm going to show you this in just a moment, but I want to think about what these charts are saying for a moment. So a quick signpost here. Really, what I think a lot of the data that we're getting today is saying is, first of all, don't sue me, bro. But second of all, is patience. That has probably been the hardest thing for me to learn over the last years, because everything's always been so fast. And since the beginning of 2022, back in that January when I sold, and then, obviously later I started rebuying, and then I launched an ETF and a real estate startup and stuff. Over all that time, the biggest thing I learned is these cycles take a lot longer than we think. And yesterday, there were actually some calls that we might not see a recession until 2024. And so what feels weird is it feels like we keep kicking the can down the road. I mean, yesterday in the course member live stream, we briefly went through some of the JPM numbers. And I'll tell you, those JPM numbers, without going through and rehashing all of it now, the JPM numbers were amazing. I mean, yeah, average deposits were starting to move down a little bit. A lot of that has to do with people moving money over into money markets. But credit card and debit card data is still up substantially. Lending is up. Revenue is up. I mean, JPM was absolutely destroying it. I still don't want to be involved with JPM, but when you look at credit losses, you're actually seeing credit losses decline. At industrials like Fastenal, you're seeing credit losses decline, like the rate of growth of credit losses. They're still increasing in some cases, but they're barely increasing. JPM barely increasing credit losses. I think one of the only places that I've actually seen increased credit losses has been CarMax. But then again, you're dealing with used car buyers who are more likely to be subprime, which is bad credit score, right? So overall, I have to say, here we are in April. We could potentially have another year of no recession. I'm not saying there won't be a recession. It's just we keep kicking the damn thing down the road. The more we kick it down the road, the better, though. Because the more we kick it down the road, the more the cancer of inflation is potentially negative. And we just go back to cranking the money print. I'm not saying that's exactly what we want, because we don't want to just repeat this over and over and over again and end up with 3 waves of inflation like the 70s, right? But I already debunked the 3 waves of inflation yesterday. You can type into YouTube 3 waves of inflation, me, Kevin, you'll see what. But look at this. This is really fascinating. Equities on average continue to rise after the last Fed rate hike. Oh, well, that was interesting. Look at that. Here's the end of the hiking cycle, that middle line right there. You get some volatility going into it, but on average, it looks like most equities tend to rise slightly after the last Fed rate hike. However, on average, you tend to get a fall on average after the first cut. Now, obviously, I've made the argument many times before that the reason the Fed would cut is because the cancer of inflation is gone. They're not going to cut until that happens. And in my opinion, there's a chance the stock market could actually see through that because, again, once the cancer is gone, it's like, okay, yeah, we just have to go through a little bit of pain and then we're good again, right? Who knows? But that has happened before. Look, for example, at the stock market in the 1980 recession, which is interesting because that came right before the Paul Volcker, but they were raising rates to fight inflation without having to go Paul Volcker level yet. And look at what happened. It's this light blue line right here above that red line I just drew. Equities did very well. In fact, from the cut to the end of the 1980 cycle, stocks went up like 25%. However, when we got Paul Volckered, stocks actually went down about, I'd say about 15%. And then the average is the red line here. Now the average is actually phenomenal. The average suggests flat. So that's weird because everybody's like, oh my God, the first rate cut's gonna crash the market. Well, not really. The average is the red line right there and it shows flat after the first rate cut, but after the pause, you actually get about a 7 to 8% rally in stocks. Kind of interesting. This is really interesting data. All of this data isn't very bearish. Combine it with PPI, retail sales, CPI, PCE from last month. A lot of the data that we're getting just is not that terrible. Now, this was the breadth indicator that we had talked about And Bank of America is basically also reiterating how this is a bullish signal. Basically, this was the Bloomberg chart that I shared yesterday, essentially suggesting that, oh, this is bullish. Like usually when this indicator flips, it's very bullish for markets. And that thrust indicator flipped. We talked about it yesterday. Bank of America did a whole piece reiterating how bullish it is. Now, I didn't want to get blindly bullish here. I feel like I'm already bullish enough. But I think the argument here is we might still have time. We might still have a good chunk of patience ahead of us before we actually hit a recession. It might not be as soon as June or July. It could be a Christmas recession or a Q1 of 24 recession. And by that point, it could be so mild because inflation could be so low. I mean, who knows? But it'll be very interesting to pay attention to. And I think now we've got a couple good leading indicators, not only the small business leading indicators, but personally, if you want an easy one, look for that inflection in hotel rooms because we have not seen that inflection in hotel rooms yet. So I know it feels nuanced, but it very much hits people's sentiment when they, or it's evidence of people's sentiment changing when they stop traveling, right? And I think that's really, throws back to the Ross Gerber argument, which is there's no recession. Looking around at basically what people are actually physically doing. So we like to refer to that as our Ross Gerber research, where you physically go somewhere. Like yesterday, I went to Red Robin, and I'm like, oh my God, there are a lot of people here. And I thought this was a charity because they lose money. Anyway, so that's some of my thoughts on the recession here. If you so please make sure to check out the programs on Building Your Wealth link down below. You have lifetime access to the courses on Building Your Wealth. You can buy now, pay later to join. Probably about 40% of people who are signing up right now are using BNPL, which is pretty awesome. It gets people in who've been waiting to get in, and hopefully we can build your wealth to make it so you never have to use BNPL again. Let's get you out of there. So a pretty good trade the other day too. Hope to do some more of those. So you get buy sell alerts as well in the Stocks Insight group. And folks, let's get to the next segment.